In this video, we're going to go ahead and move forward into chapter 2 and really take a little bit of a deeper look, a little further into the financial statements. We've kind of exposed you just a little bit on the high level. Now we're going to start looking a little bit deeper. So some of the things that you're going to be looking at is identifying the sections of the balance sheet, using ratios to evaluate a company's profitability, liquidity, and solvency, and discussing some of the financial reporting concepts. You'll recall from the earlier chapter that the classified balance sheet is a reporting of the organization at a significant point in time. We often call it a snapshot at a point in time. It groups similar assets and similar liabilities together using some standard classifications and some sections. This is really helpful because within the groups, there are some similar economic characteristics. Makes the information more easily usable. The groupings help users determine whether a company has enough assets to pay its debts, what claims there are by short-term and long-term creditors that exist on the total assets, what type of assets the company has, and what quantity of assets the company has for long-term operational purposes. It really does serve several purposes for the user. The standard classifications will be current assets, long-term investments, property, plants, and equipment, intangible assets, current liabilities, long-term liabilities, and stockholders' equity. We'll look at all of these different types of classifications a little bit more in depth here later. Let's look at the classified balance sheet and a representation of it for Franklin Corporation. So here we're looking at the assets section. This is just part of it, of the classified balance sheet. You'll see that what has been termed a current asset and all of the accounts within that are then totaled here. You'll see the long-term investments, the accounts that fall into that classification, and then their total here. We have our plants, property, and equipment, being land, equipment. You'll see this little account here that says less accumulated depreciation equipment, and then the difference that contribute to the total for that here. We'll talk more about depreciation and land and things of that nature as we go on. With total assets of $61,400. You'll notice that that is equal to the total liabilities and stockholders' equity. Just as a quick reminder, the accounting equation is assets equals liabilities plus stockholders' equity, and the balance sheet is a representation of that information. Here we have our current liabilities, notes payable, accounts payable, unearned sales revenue, and some others totaling $16,050. The long-term liabilities totaling $11,300 for total liabilities of $27,350. Now, we'll get into these a little bit more, and we'll talk some more about accounts receivable, accounts payable, notes receivable, notes payable. But to start off with, we're going to really talk about current assets. So current assets are those assets that we can expect to convert to cash or use up in the business within 1 year or the operating cycle, whichever is longer. So there's a time threshold when we talk about the word current. If you hear current, you need to think within 1 year or the operating cycle, whichever is longer. Now, the operating cycle is going to be a relatively new kind of term for you. The operating cycle is the amount of time that it takes from the initial investment or the purchase in inventory. So from the point we buy something that we intend to sell, the amount of time we hold it, it is sold, and then also the collection time it takes for us to collect from our customers. So if we sell it on terms, meaning that we say you can have 30 days to pay, that additional 30 days is part of that operating cycle. It's the period from cash to cash. Some common types of current assets are cash, investments, receivables, inventories, and prepaid expenses. We'll talk about these more in depth as we go through the class. One of the great resources you have in your text is in the beginning of the book is some sheets that talk about account classification and presentation. And it's alphabetical and will tell you an account title, what its classification is, what report it's on, and what a normal balance for it is. Now, I don't want you to get hung up on normal balance in this chapter. We'll talk about that much more in depth as we continue to go forward. Examples of these current assets, such as, of course, cash, are short-term investments. Short-term also means current. The different types of receivables we might have are accounts receivables, notes receivables, and interest receivables. And prepaid expenses we'll go into more in depth, but that could be things such as rent, supplies, insurance, and advertising. On the current balance sheet, current assets are listed in the order in which they're expected to be converted into cash. So that is also called the order of liquidity. So those that are more liquid, more likely to be converted to cash more quickly, are going to be at the top. Those that are less liquid, those that are less likely to convert to cash as quickly, will be at the bottom. So we're just going to go back one slide real quick, and you'll notice that we talk about receivables here. I just want to take a minute and kind of discuss that there are different types of receivables. And what a receivable is it says that another party owes the organization, the entity, the company, consideration or money. There are two different types of receivables that often will rear their heads. And they're not represented on this section of the current assets on the balance sheet, the classified balance sheet. But we come backwards just a hair to the Franklin balance sheet. You'll notice we have accounts receivable of $7,000 and notes receivable of $1,000. A notes receivable can be either current or long-term. It depends upon the time involved with that note. Accounts receivables are short-term in nature, typically 30, 60, 90 days. Not often farther beyond that, but there are some industries that have terms of 6 months. So, for example, I am a spa or gift shop, and I order a product from my supplier. My supplier sends me that product and gives me 6 months before I have to pay for it. That is less than a year or an operating cycle. Therefore, it's current. because it is wrapped into the basic terms, and I have that period of time to pay that exact amount, that is an accounts receivable. A notes receivable is a little bit different. They're more formal, they're structured, they're typically backed by some type of a written contract. They also will usually have attached to them some type of an interest component. Think of taking out a loan from somebody. Now, that loan may have terms that you pay every month, or that loan may have terms that I will pay the full $5,000 I borrowed plus 3% interest in 9 months. It can go either direction. We do dig into that a little bit more in later chapters, of course. But I just wanted you to know that sometimes a notes receivable is a current asset. Sometimes a notes receivable is a long-term investment. And that the difference between a notes receivable and accounts receivable is the formal structure. There's usually an interest component. There are repayment terms that are attached to it, typically. And we'll go much farther into depth on how those different things go into play in a later chapter. So let's just take a second and go over this review question. Cash and other resources that are reasonably expected to be realized in cash or sold or consumed in the business within 1 year or the operating cycle are called what? Are those current assets? Are those long-term investments? Are those intangible assets? Are those property, plant, and equipment? Based off the information you have received thus far, you should come to the conclusion that those are current assets. The next section on the classified balance sheet is long-term investments. So these are assets that can be converted into cash, but that conversion is not expected to happen within the 1 year operating cycle threshold. It's expected to happen after that. It's longer term. These include assets that are not currently used in the company's operations. So this is not the land or the buildings, things of that nature. These are investments in stocks and bonds of other corporations that are intended to be held for more than 1 year. These are long-term notes receivables. So you make a loan and the repayment on it is not for 2 or 3 years. As I said, notes receivables can fall into both long-term investments and current assets. It depends on the maturity and the terms of that specific loan. In many of our very large Fortune 500 corporations, there are teams of people that do nothing but take care of long-term assets. The next section in assets in the classified balance sheet is property, plants, and equipment. So these are assets that have relatively long useful lives. They're not going to be used up or consumed within the course of a year. They're also sometimes called fixed assets or plant assets. They are used in the actual operations of the business. These are the assets that are used to generate the revenues. Sometimes being called fixed or plant assets can kind of throw you when you're looking at a annual report. Just know that the terms are synonymous. Some examples are land, buildings, machinery, equipment, furniture and fixtures, delivery vehicles, land improvements. Again, these are all things that we will go into greater detail in later chapters. Attached to your property, plants, and equipment, though, is depreciation. There's an account that is a contra account, meaning that its balance is contrary to the normal balance in that particular section. And that contra account, called accumulated depreciation, represents the total amount of depreciation that has been expensed thus far in the asset's life. We do go through a chapter talking about depreciation more in depth, but depreciation is not a valuation technique. What it is it's an allocation of the cost over the periods in which an asset will benefit the business. Your balance sheet does not necessarily show the value of everything in the organization. Accounting records things at cost, not value. Let's take a quick look at the property, plant, and equipment section of a balance sheet for Tesla Motors. You can see here they have machinery, equipment, and office furniture. They have tooling machines. They have leasehold improvements, buildings and buildings improvements, land, computer equipment and software, and then they have some construction in progress. There at the bottom, you'll see that of the $878,636 that they have actually paid and invested in property, plants, and equipment. To date, they have expensed $140,142, leaving a carrying or book value of $738,494. Now, the next asset is a little less overt and obvious. That is the intangible assets. Sometimes you'll get a really broad heading in a financial statement that's other assets, and the intangible assets may be wrapped up in those. Intangible assets don't have physical substance, and they include things such as goodwill, patents, copyrights, trademarks, or trade names. This topic is really addressed in depth later in Chapter 9. But let's just stop and think for a minute. Some companies purchase other companies. When the net assets of the company that is being purchased equal, let's say, $3,000, but we are paying $5,000 for it, that $2,000 difference is what's called goodwill. It represents things such as a company's relationship with its customers, its, to use the word very nebulously, brand. But that is goodwill. Patents are something that are sold all of the time. The same is true with copyrights. Trademarks, less likely to be sold because they tend to tie very directly to the organization. However, that may be something that would be sold if somebody was selling just a piece of their business. Intangible assets are not depreciated. They are amortized. So you'll see here an accumulated amortization account. How they're treated depends upon the assets, and that is something that in Chapter 9 we'll go into much more depth about. We'll end this video here, And we'll talk about the liabilities and stockholders' equity section in the next video. But before we break, can you tell me what patents and copyrights are? What type of assets are they? They current assets, intangible assets, long-term investments, or property, plants, and equipment. Patents and copyrights don't actually have a physical substance, so they would be intangible assets.